Good afternoon and welcome to lecture 12 of ETC 779. In this particular lecture, we are going to learn one more method of evaluation of different alternatives. Prior to this lecture, we have already covered present worth method of analysis, future worth method of analysis, annual cost and worth method, and today we are going to learn about one more method that is called incremental analysis. Now, this incremental analysis can be performed for present cost method, for annual cost method, as well as for future cost method or future worth method. But we will be starting this particular method's explanation with incremental rate of return method. If you remember, while discussing the internal rate of return method, I had told you that this particular method, that is internal rate of return method, cannot be used for situations involving cost dominated cash flow diagrams as well as revenue dominated cash flow diagrams. Similarly, whatever methods we have discussed till now, they are useful for evaluating two alternatives at a time. When you have got more than two alternatives, we use incremental analysis. Whenever we have got more than two alternatives before us, we use incremental method of analysis. Now, this incremental analysis could be with present worth method, could be with future worth method, could be with rate of return method. So, we are starting with incremental rate of return method of comparison. Now, before going into the details of this method, I would like to define what is meant by incremental. Suppose I have got three alternatives with me: alternative A, alternative B and alternative C. Suppose alternative A requires 100,000 investment, 100,000 rupees investment. Alternative B requires 150,000 investment and alternative C requires 200,000 rupees worth investment. So, we have got these three proposals before us, right. Now, what we do, just like we have been doing it in earlier methods, we calculate the rate of return for all these three alternatives, for alternative A, for alternative B and for alternative C. And then what we do, we compare this rate of return with MARR, which is minimum attractive rate of return, right. Now, suppose that for all these three alternatives A, B and C, we get the rate of return which is higher than the MARR values, right. Suppose MARR value is 10%. Suppose the company has fixed the minimum attractive rate of return equivalent to 10%. Now, let us further assume that alternative A, alternative B and alternative C, all these three alternatives are giving you more than 10% of return, right. So, what do we do next? That means all three alternatives are qualifying my criteria. They are all above that minimum value. Now, out of these three, I have to select only one. Now, here also I assume two things. First thing is that if I find that the lowest investment option is the best, that means 100,000 rupees investment, suppose I find that that is the best available option with me, then I assume that the surplus money which is left out with this investment, I have got options available to invest this surplus money. This is assumption number 1. That means any money left out after going in for the lowest option, I have got different options available through which I can earn more than the minimum attractive rate of return. This is assumption number 1. The second assumption is that suppose my analysis shows that the highest investment option is the most economical one, then I have got that much money available with me. That is second assumption. That means there is no scarcity of fund should I require the option with the maximum investment, right? So these two are assumptions on which the incremental analysis is based. First assumption, any money left out, I have got options to invest it further, which is going to give me more than the minimum attractive rate of return. Second assumption, if I happen to find that option with the maximum investment is most economical, then I have no crunch of money. So that means I have got that much fund available with me. So these are the two assumptions. Now coming back to incremental analysis, the basic idea behind performing incremental analysis is that every rupee of investment is as good as the other. If you notice the last line in this, I have written the incremental analysis is based on the principle that every rupee of investment is as good as the other. If you are not able to copy the slides, don't worry, I will send these slides again to you through email, right? So just listen to what we are discussing right now. The incremental analysis is based on the principle that every rupee of investment is as good as the other. What does this mean? Alternative A, I am investing rupees 100,000. Alternative B, I have to invest 150,000. Alternative C, I have to invest 200,000 rupees. Now I have already performed the calculations for rate of return for each of these three alternatives, and I have found that all of them are giving me a return more than the minimum attractive rate of return. So first qualification, it clears, all the alternative is clearing my first requirement, that the returns should be more than the minimum attractive rate of return. Now not only this, I have to also look at the situation and I have to see that every additional money that I am putting in for next higher investment option, whether that extra money also is giving me a return higher than the minimum attractive rate of return. So what I will do? I will take the difference between the lowest value and the next lower value. So how much extra we are to invest if I go for alternative B when compared to alternative A? I have to invest extra 50,000. Why? Alternative A requires 100,000, alternative B requires 150,000. So if I am preferring to choose 150,000 option, so how much extra I have to put over and above alternative A? That is 50,000. So next thing that I have to see is whether this additional 50,000, is also fetching me a return higher than the MARR. If yes, then I will go for option B. If no, I will be sticking with option A only. Is it clear? So what we are looking for? Whether the additional investment that I am putting over and above the lowest one, is it also giving me a return higher than the minimum attractive value? If yes, I will go for higher option, otherwise I continue to go for lowest option. Now, so let us say A and B I have compared and I have found that B is not lucrative. That means the additional 50,000 is not giving me a return more than the MARR value. So what I do next? Now I compare A with C, right? Now I have to compare A with C. Then again I have to see how much extra money we are putting in. So what is the difference between C and A? 200,000 minus 100,000. So what I will see, whether this 100,000 additional investment in C is giving me a return more than MARR values. If yes, I will choose option C. If no, I will say that option A is the best option among these three alternatives. So this is how we proceed whenever we have got more than two alternatives. Remember, whenever you are having more than two alternatives, always perform incremental analysis. I repeat it once again, whenever you have got more than two alternatives, always use incremental analysis. Now within incremental analysis, you can use incremental present worth analysis or incremental future worth analysis or incremental cost method or incremental rate of return method. So these are the concepts of incremental analysis. How to perform this incremental analysis, although I have just explained you, I will give you a step by step process through which you will find it is very easy to calculate. So step 1, you can note it down. Step 1 is listing out all the alternatives in ascending order of their first cost. First cost is how much money you are paying now at time t is equal to 0. Now you may appreciate that in most cases alternatives with the lowest investment are likely to turn out to be the do nothing alternative, right? So do nothing is also an alternative. Suppose you are entering into a new market, right? You want to develop a product, right? Now you have got three options before you. You can invest in a smaller plant or a small factory, a medium sized factory, which you can extend it if the demand is more at a later date. And third alternative could be right at the beginning you go for a large plant or large factory. Now in addition to these three alternatives, one more alternative is before you, and what is that? Do nothing, right? So do nothing alternative, you will find that is the lowest investment option before you in most of the problems, right? So you will have four options here. Do nothing is the first option. Second option is go for a small factory. Third option would be go for a medium factory which can be extended later. Alternative 4 could be go for a large factory or a large plant right at the beginning. Now, for each of these you have to estimate the cost. Okay, how much is a small plant costing me? How much is medium size plant costing me? How much is large size plant costing me? So, until and unless you know the cost, you won't be able to proceed further in the analysis. So, step 1 is generate all the possible alternatives. That is what is written here. List out all the alternatives in ascending order. That means lowest you write at the beginning, then you go on in an ascending manner, right. So, that means lowest you write as the first and the highest investment option you write it as the last one, right. So, this is as far as step 1 is concerned. What we do in step 2? Compare the rate of return of all the alternatives with the assumed MARR. So, the value of MARR would be given to you. It may be 10%, 12%, 15% depending on the type of business. You will be told that minimum attractive rate of return is this, right. So, if you see this particular slide, you have to compare the rate of return of all the alternatives with the assumed MARR value and check if the rate of return is at least equal to the MARR. If it is not the case, then we drop the alternative here itself and we do not take them for further analysis, right. So, if you just say, if I take an example here, I will just take one example. Suppose I have 4 alternatives: alternative A, alternative B, alternative C and alternative D. These are the 4 alternatives. Let us say alternative A is costing me 0. This is nothing but do nothing alternative. Just sit idle, that is all, do not have to do anything. So, naturally your cost would be nil. Now, let us say in alternative B you have to invest 100,000. In alternative C, let us say you have to invest 150,000. In alternative D, let us say you have to invest 200,000. So, what I have done? I have arranged them in ascending order. The lowest one, which is the do nothing alternative, I have kept right at the beginning. Then I have brought the next higher alternative, which is 100,000 rupees, then next 150,000, and the largest investment I have kept as the last option, right. Now, what I do? I calculate the rate of return. Rate of return, I calculate I value for all these cases. How do we calculate this? For this, we will be provided additional information which will help us or which will make us calculate the rate of return. Now, suppose the rate of return here is 12%, 15% and let us say 16%. This I am just giving you an hypothetical example in which I am finding that rate of return given by this investment option is 12%, here it is 15%, here it is 16%. Now, suppose my MARR is 10%, then all these alternatives except A, suppose this is cancelled, all these alternatives B, C and D, they qualify for next level of analysis. the alternative A doesn't qualify because this is giving you 0% return. You are not putting anything, you are not getting anything, right. So, that will be dropped from further analysis and we will be considering only B, C and D. Now, suppose it is given that MARR is 15%. Suppose in next example it is given that MARR is 15%. So, which alternatives will be dropped out here? Alternative A would be dropped because it is giving you 0 return. Alternative B would also be dropped. Why? Because this is giving you a return of only 12%, which is less than 15% value. So, in next level of analysis, we will take only options C and D, right. Now, what we do is, in step 3 if you see, I have put it in the slide, it says prepare the cash flow diagram on incremental basis between the alternatives which is being examined and the current alternative with the lowest initial investment. So, what we are doing now? Once this initial screening has been done, we take out one alternative at a time and compare it with the lowest one. So, suppose you are left out with A, B and C, then I will take A first and I will compare it with B. Now, if I find that the additional investment is giving me a higher return than the MARR, then I will adopt B for next stage and I will drop out A, simply because B is more advantageous to pursue further. Then I will compare B with C. If I find that the additional investment is not giving me a higher return than MARR, then I will drop C and I will say that option B is the best. So, this is how we proceed. This will be more clear. Just note down step 4 also. This is what we have discussed just now. When an alternative which had just been examined is acceptable, that means rate of return is more than MARR, it becomes the current best replacing the earlier one. Now, the new best is examined with the next higher investment alternative, right. Then we move on to step 5. Step 5 is, in case rate of return is less than MARR, the alternative under examination is ruled out and the current alternatives remain the lucrative one. Then the current best is compared to the next higher investment. And finally, this process from step 1 to step 5 is repeated till all the alternatives have been looked into and the best alternative is selected. So, step 1 was find the rate of return. First you arrange them in ascending order, find the rate of return for all the alternatives, compare it with minimum attractive rate of return. If they are all greater than MARR, select all of them for next stage of analysis, otherwise drop those alternatives which are giving you lower values than MARR, right. Then you compare the lowest one with the next lower and find the return on the additional investment. If the rate of return is more than MARR, you continue it and then you perform the similar set of calculations for other alternatives also. Now I will just try to give you an illustration. In which I have assumed that, yes, a construction company is purchasing aluminium doors at rupees 3550 per piece from a vendor. Yes, please.
The class was interrupted for 2 minutes, please. Would you remind me?
Yeah, we are discussing an illustration. To show you the different steps that I have discussed just now. I am trying to work out an example using the steps that I have just told you. For that, I am considering a construction company and I am assuming that it is purchasing aluminium doors. One door is costing rupees 3550. So the construction company is purchasing these doors from a vendor, from a supplier at a rate of rupees 3550. Now the annual demand for the doors is 350 numbers. That means every year the company is buying 350 doors from this vendor. In order to develop the in-house capabilities for production of aluminium doors, the company requires investment in equipment to produce aluminium doors at an initial cost of 1,050,000 initially, rupees 925,000 at the end of first year and rupees 612,500 each year at the end of year 2 and 3. So what is happening here? Company has two options. One, it continues to buy the doors from a vendor, and second option before it, they can buy equipment through which they can produce these doors internally or in-house. For that, they have to buy an equipment for which the initial cost is given and the cost at the end of year 2 and 3 is also given. What other information we have? The equipment will have no salvage value at the end of year 3. I am assuming that this equipment when sold at the end of year 3 will not give me any money. So its salvage value is 0. Now the question before us is, should the company develop in-house capabilities or continue to buy aluminium doors from its vendors? That means what we have to do, we have to see this problem and find out whether the company should develop in-house capabilities or continue to buy aluminium door from its vendors. So for solving this problem using incremental rate of return method, the step 1 would be to draw the cash flow diagram. Right? That is the basic first step for any method of evaluation. You develop the cash flow diagrams for all the alternatives that is given in your problem. So here alternative 1 is procure the doors from the vendors. Second alternative is buy your own set of equipment and produce it internally. So these are the two options we are trying to evaluate. So the first thing, that means step 1 would be to draw the cash flow diagram for these two options. So, I have drawn it in this particular slide, if you see. So, the first diagram is for the option in which the doors are procured from the vendor. The doors are procured from the vendor. I will just try to do it on this piece of paper so that it is more clear to you how I have drawn the cash flow diagram. So, I will draw the cash flow diagram for option 1 first. The period of analysis is 3 years. So, this is year 1, this is year, let us say 2, and this is end of year 3. I am at t is equal to 0. So, at time t is equal to 0, time t is equal to 1 year, time t is equal to 2 years, time t is equal to 3 years. Now, each door is costing the contractor 3,550 rupees. Now, demand every year is 350. So, the total cost it incurs is rupees 3550 into 350. If you calculate this, you will find that this is coming to be 1242500, right. So, that means this much cost you are incurring every year if you buy 350 pieces of door frames at a rate of rupees 3550. So, this value will be constant for all the 3 years. Here also it is like this, here also it is like this. So, this is the cash flow for option 1, cash flow for vendor option. That means when you are procuring the aluminum doors from the vendor. Now, I have to draw the cash flow diagram for the situation in which the company will produce its own aluminum doors. So, for that the cash flow diagram would be like this. At time t is equal to 0, you are supposed to invest 1050,000. At time t is equal to 1, you are supposed to invest 925,000. At the end of year 2 and 3, 612,500 and 612,500. This is t is equal to 1, t is equal to 2 and t is equal to 3. So, this is the cash flow for option 2. That means when we are procuring the equipment and producing our doors internally, that means in-house. Now, what we will do is, we will have to prepare a incremental cash flow diagram. Now, this is the first time this incremental cash flow diagram, we are going to draw it for the first time. So, for this you have to look at this particular piece of paper very carefully. We are trying to find the additional investment required and the additional benefit that it is generating. So, basically incremental cash flow diagram is what? It is nothing but the pictorial representation of additional investment required and the additional benefit that it generates. So, for this just try to look at these two pictures. Here how much I am investing? 0. At time t is equal to 0, my investment in option 1 is 0. Whereas in option 2 I have to invest 1050,000. So, how much additional money we have to invest at time t is equal to 0? 1050,000 minus 0. This, let us say I put it 0 here. So, this is the difference that I have to invest now. That means additional investment that I need to put in option 2 is 1050,000, right. Now, by putting this extra money, how much additional benefit we are getting? For that, we have to find the difference of this value and this value. In option 1, I have to put 1242.500, that means 1242500. It is nothing but 12,42,500, right. In option 2, I am putting 925,000. So, how much would be the saving in year 1? The difference of the two. Similarly, here also I will find the difference between this and this. Here also I will find the difference, this and this. Now, once I understand this, it will be very easy for me to draw the incremental cash flow diagram, which will be something like this. At time t is equal to 0, I am putting how much extra money? 1050,000. How much benefit I am getting at the end of year 1? This would be 317500 at the end of year 1. Similarly, at the end of year 2, I am getting 630,000. At the end of year 3 also, I am getting 630,000. This is the incremental analysis. Incremental basis cash flow diagram. What I have done is, how much money I have put extra at time t is equal to 0, and what are the returns that this extra investment is fetching me at the end of year 1, at the end of year 2 and at the end of year 3. Now, based on this cash flow diagram, I will be able to find out the rate of return for this. How do I find the rate of return? Again, this will be done on a trial and error basis. So, I will assume some I value, let us say to start with I assume, in step 1 let us say I assume I is equal to 20%, right. Then at this I value I calculate the net present worth. So, I calculate the net present worth at this I value, right. So, these set of calculations I have performed in this particular slide. I will just directly take you to the solution. So, if you just look at this slide, what I have done is I have assumed I is equal to 20% to start with, and then I have calculated net present value. The net present value would be based on this incremental cash flow diagram. Pardon me? Yes? That you will get the slides, because we can't continue to go back. I will just show you this how it is done. I will send you the slides. We are discussing one problem in which, if you just see the previous slides, did you note down the problem? Did you note down this particular slide? Okay, so we are discussing a problem in which a construction company has got two options. It can take the material aluminum door from the supplier at rupees 3,550 per piece, and demand for such doors are 350 pieces every year. And we are also given the other option through which company can manufacture these aluminum doors internally or in-house. So, for that you can purchase the equipment initially at a given cost. It is given 1,050,000. Then first year you have to put more money, 925,000. And end of year 2 and 3 you have to put 612,500. The equipment doesn't have any salvage value at the end of year 3. We are discussing whether the company should produce the doors internally or whether it should continue to buy from vendor as it is doing now. So, for this, as we discussed, we can draw the two cash flow diagrams. If you see the first cash flow diagram, you are having a value 1242500. This is nothing but the multiplication of product of 3,550 multiplied by 350. That means every year the company has to pay this much money. Then in second case, when you are trying to buy your own equipment and going to produce the doors, the cash flow diagram is like this: 1050000. This you have to put at time t is equal to 0, 925,000 at time t is equal to 1, and at t is equal to 2 and 3, 612,500. Right? Now, what we are doing here is that, based on this, if you remember our previous discussion, individually we won't be in a position to calculate the internal rate of return. Why? Because these two cash flow diagrams are cost dominated. We are not having any information on the revenue part. So, individually we cannot find out the rate of return. So, what we do? We combine these two cash flow diagrams on incremental basis, so that we have a mixed type of cash flow diagram. Mixed type of cash flow diagram, if you remember, it has figures on both plus as well as minus side. So what you have to do is, you have to see how much extra money you are investing in option 2 when compared to option 1. How much money extra we are investing? At time t is equal to 0, 1000, 50,000, 1050, 000. This is the additional investment over and above option 1. Just take the difference 1050, 000 minus 0, because in option 1 at time t is equal to 0, you are not putting any money. So this is the extra investment that you need to do. Naturally, when you are putting this extra money, you will be getting some benefit. So what are those benefits? We will be getting benefit at the end of year 1, at the end of year 2, at the end of year 3. How? In option 1, you are putting 1242500, whereas in option 2, you are putting 925,000. So you have to put less cost. That means this is your benefit. So this is how we go on subtracting, and finally you will get a cash flow diagram like this. What is happening here? At time t is equal to 0, you are investing some extra money, which is equal to 1050, 000, and this is giving you a benefit of 317500 at time t is equal to 1, 630000 at time t is equal to 2, and again 630000 at time t is equal to 3. Is it clear to you, technology class?
Yes.
Good. Now what we have done? We have converted two cost dominated cash flow diagrams into a single mixed kind of cash flow diagrams. Now I will be in a position to compute its rate of return. Now when I calculate the rate of return for this, I will show you how do we calculate. Already you know this. I will have to compare that with MARR value. If I find that this rate of return is more than the minimum attractive rate of return, that means I will go for in-house production of doors. Right? That means the additional investment is justified. Why? Because it is giving me a return which is higher than the minimum value set by the company. Now how do we calculate the rate of return for this? If you just see the cash flow diagram that we have done, how do we calculate the cash rate of return? By trial and error process. So for first trial, let me assume I is equal to 20%. Now at this I value, I will calculate the net present worth of the cash flow diagram. It is very simple, you already know how it is done. So net present worth, you will find that it will be equal to 1660.48. This you can cross check. That means net present worth is positive. So I will again increase the I value in second trial. I have assumed I to be 21%. So I find that net present worth is coming to be negative now, minus 1677.13. So I have got two values, one value is positive, one value is negative. So that means my net present worth equal to 0 would lie in between these two values, 20 and 21. So, that I have calculated using interpolation, and I have found that the rate of return, that means I for this particular value is 20.908%. This you can cross check it and tell me its result, whether I have done the calculation correctly or not. So, I value that I have got for this problem is 20.908. Now, suppose my minimum attractive rate of return is given to be 15%. So, which option you will choose? Construction company will choose which option? Since the rate of return that you are getting is higher than 15%, so you will go for option in which you are procuring the equipment and producing the doors in-house. Now, let us say if the MAR value would have been 25%, in that case you will have to go for procurement of aluminum doors through the vendor. So, the decision will depend on what is your minimum attractive rate of return, and then you will be able to take appropriate decisions, right. I will take one more example. This particular example will show you that if you try to rank the alternative using IRRR, internal rate of return method, you may give a wrong result, right. In the beginning also, while discussing internal rate of return, I had told you that never use these methods for ranking of projects. You may find error in your decision. So, whenever you have to select alternative out of number of alternatives, always perform incremental analysis. More than 2 alternatives, always perform incremental analysis. It could be incremental present worth analysis, incremental future worth analysis, or incremental rate of return analysis. I have tried to explain you these concepts using this particular problem, right. So, the problem statement is there are two projects, project X and project Y. There are two projects, project X and project Y. Project X needs investment of 50,000 at time t is equal to 0. I have used the sign minus. Minus 50,000 means that I have to invest 50,000 in this particular project. And when are we getting the returns? At the end of year 1, I am getting 5,000. At the end of year 2, I am getting 17,500. At the end of year 3, 30,000. At the end of year 4, 42,500. In project Y, again you have to invest 50,000 and you are getting a return of 50,000 at the end of year 1, 10,000 at the end of year 2, another 10,000 at the end of year 3, and finally another 10,000 at the end of year 4. Now, this problem I have tried to solve using present worth method, annual cost method, and internal rate of return method. All the three methods. right. So, let us start with cash flow diagram for option 1, that is for project X. 50,000 you are investing at time t is equal to 0. 5,000 you are getting the return at end of year 1, 17,500 at end of year 2, 30,000 at the end of year 3 and 42,500 at the end of year 4. Now, the cash flow diagram for option Y, project Y. 50,000 I am investing now, I am getting a return of 50,000 at the end of year 1, 10,000 at the end of year 2, end of year 3 and end of year 4, all equal sum rupees 10,000. Now, let me calculate using present worth analysis. It is very easy to find the net present worth for option X. It would be given by minus 50,000 plus 5,000 multiplied by P given F, interest rate 10%, period 1 plus 17,500 into P given F, 10%, period is 2. Likewise, I can also calculate the net present worth for option B or option Y. So, what you find that if you try to perform the calculation, you will find that net present worth for project X is coming to be positive, which is 20,574. Right? You can cross check all these calculations on your own, right. So, for X I have calculated the net present worth. Similarly, I can calculate the net present worth for option Y. I find that net present worth for option Y or project Y is 18,062. So, which option I will choose? I will choose project X. Why? Because for project X, the net present worth is more than the project Y's net present worth. So, option is X using present worth method. Now, let us go to another method of analysis, annual cost analysis. Here also I can calculate the equivalent annual cost. How do I calculate equivalent annual cost? By using the factor A given P at 10% interest rate and different time periods. I find that the equivalent annual cost for project X is rupees 6,490. All these things you can calculate now. You have got sufficient background for all these methods. Only thing you have to draw the cash flow diagram and then use that cash flow diagram to find out either the present worth, future worth or annual cost. So, annual cost for project X is rupees 6,490 rupees. Similarly, I can calculate the equivalent annual cost for project Y. What I find here is the equivalent annual cost for option Y is rupees 5,698. So, which project I will choose? Again, I will be choosing project X, since the equivalent annual cost for X is higher. Now, let us try to work this out using internal rate of return method. For this, again I have to work with trial and error. I will assume that I is 20%. So, at this assumed value of I, net present is found to be positive 4177.25, right. So, what I have to do? I have to take a value higher than this interest rate. So, I further assume that I is equal to 25%. I get a net present worth of negative minus 2032. So, by interpolation I can calculate the I value to be 23.364%. So, that means project X is fetching you a return of 23.364%. Same type of calculation I will be performing for project Y also. For project Y, let us assume I is equal to 35%. So, net present worth I am finding it to be minus 43. Similar calculations I perform for other interest rate, and I find that interest rate is coming to be 34.9%. That means, using this method, which project I should select? I will have to choose option Y or project Y. Why? Because it is giving me higher rate of return. So, what you find here is that you are getting two different answers. First two methods gave you answer of X, while the rate of return method is giving you a different answer. So, this is the problem you will be facing if you try to compare the two alternatives using internal rate of return method. Now, the same problem I have tried to use incremental rate of return method. In this, I have drawn the incremental cash flow diagram, which is shown in this particular slide. At time t is equal to 0, you are having 0 cash flow. At time t is equal to 1, it is 45,000, and at time t is equal to 2, you are getting a return of 7,500. At the end of year 3, you are getting a return of 20,000, and finally at the end of year 3, you are getting a return of 32,500. Now, using this cash flow diagram, you can calculate the rate of return, and it is found to be 12.9%, which is higher than the minimum attractive rate of return, which is 10%. So, that means you can prefer X over Y. So, what it has finally shown us is that if we are using incremental rate of return analysis, the results or the decisions will be consistent with other methods also. So, at this point we will try to wind up this lecture, and in next lecture I will be trying to discuss different methods of depreciation and its implication on taxes. So, that will be in lecture 13. So, if you have got any doubt, we will be addressing those things. Thank you. तो रिकॉर्ड तो बंद कर दीजिए. Did you understand? But you were not able to see those slides, na?